Hi, good morning, everyone. It's just after 8 a.m. here in New York City or Brooklyn. I'm in Brooklyn. Um, and as usual, people can show up either on Zoom or watch this live on YouTube, um, or perhaps you're watching this as a playback at a future date. I'll give people a few minutes to get set up. And just say the contact information is going to be on the last slide. So, and as well, these slides will be made public at the end, along with the meeting minutes. So I'll mute for a few minutes. Okay, it's 8:05, so why don't we get started here? This is a series of talks called MRMD. I'll explain what that means in a minute. It's number 14, and we're going to focus today on operational risk, the models and how to validate them and how to manage. Okay, it's 8:05, so why don't we get started here? This is a series of talks called MRMD. Okay, I had a little technical problem. Anyway, here we go. It's 7 minutes after the hour, and we're going to talk about operational risk today. I'm a consultant. My company is Delta Vega Incorporated. I'm in Brooklyn, and I specialize in quant work, particularly model risk management. So what is MRMD? It's basically, you can pronounce it mermaid. It just stands for Model Risk Management Discussions. And it's associated with my co-writing a new textbook on model risk management, the first textbook of its kind. The working title is here, so you can see it's intended for financial engineers, and my co-authors are listed here as well, and it will be coming out in 2026. So here's the outline of the talk. One of the interesting things in operational risk, which I'll define in several ways, is that there are two characteristics. There's how often does an operational risk loss occur, and then how severe is that loss. And that dichotomy defines, as you'll see, how financial institutions prepare for and respond to events. But from a model perspective, it means that we may need to model both the distribution of frequency and the distribution of severity. It's first necessary to talk about the regulations, and the Basel, the Bank for International Settlements in Basel, Switzerland, has defined 7 different op risk event types. Originally, there was both the standard approach to calculating the risk capital, and there was an advanced approach. Now, the standard approach is accepted for everyone, but the advanced approach, so essentially that's for regulatory capital. But as usual, banks should consider also using advanced approaches so that they can provision for op risk economic capital internally. So that's the regulatory part, part 2. Part 3, we talked briefly about op risk data, but basically it's all proprietary. So if you're part of the consortium, you can use the data. If you're not, then you can't. So instead, we do some numerical experiments in frequency and severity distributions and see how easy it is to recover them, given that it has a certain form. And we talk about 3 different kinds of frequency distributions. They're all discrete distributions, which is something unusual. The idea of fitting a discrete distribution is not something that we normally do in finance. We're used to continuous distributions, such as a normal distribution, a t-distribution, maybe normal with skew, normal with an exponential, etc. But they're all continuous. And finally, at the end, I'll give contact information for follow-up. Slow to respond there. So here's a working definition of operational risk. I think the key word is, this is from solvency, but which is applied to insurance companies, but I think it applies equally to most financial institutions, including banks. And in particular mentions the role of people, that this is, you'll see that there are key person risk, for instance, as part of business continuity, deaths from a terrorist disaster or a hurricane. These all are involving people in a lot more direct way than, let's say, credit risk or market risk or counterparty credit risk and so on. So here's what I referred to on the initial slide, that there's a dichotomy between frequency and severity. So here's a schematic chart in which we have severity increasing on the horizontal axis. So that could be in dollars or in euros or whatever. And then we have frequency increasing on the left side. So the you know, that could be daily, that could be yearly, and so on. So that then we can talk about different regimes. We can essentially talk about uh, upper left, or if you like, the northwest part of the chart, the northeast, the center, the southwest, and the southeast. So here in the northeast corner, northwest corner, we have losses that happen frequently but are low severity. Someone gets laid off and they decide that they really like that stapler, or they steal a couple of reams of paper. That's something that are just usually just get rolled into ordinary business losses. That's not something that you're going to go after the person or insure against. Conversely, in the Southwest, if something is very rare and low severity, then it's really kind of de minimis. And that brings up the idea that there should be a floor on severity. And we'll talk about that later. In the middle of all this are sort of ideal insurer, where you could go to an insurance company and say, this happens somewhat frequently and there's a modest amount of loss in this. If this is, let's say, a few thousand to 10,000, this might be 100,000 to 10 million or something like that. So that's something you can insure against, you hope. And then over here in the northeast, so it's very, high severity losses do not happen frequently. If they did, then your bank would already be out of business. It's much more likely to have a low frequency. Think about 9/11, but a huge, or Hurricane Sandy, or a cyclone, floods, and so on. Those are hard to insure against just because they're so costly, and they really can't be predicted. We can go into how I don't feel like insurance companies really are predicting anything, because they use the historical measure and they use backward data. Insurance companies would be the ones who would predict that you don't need very many lifeboats on the Titanic because the Titanic had not yet happened, so you don't have the provision for that. So reserves are another way to do it. You just put some money aside and you calculate that somehow. All right, so let's briefly go through the Basel regulations. These things are fairly hard to go through in a talk. So on these charts, I'm going to have long tables, but I'm going to call out certain things. There are about 70 different examples of operational risk here. It's just sort of to try to get you to focus on what it is. And I'll call out with the arrows on these charts, things that are maybe a little unusual or somewhat surprising. For example, antitrust. So if a company tries to do price control by, talking to a competitor and and hence, trying to get increase its pricing power, that could certainly violate national laws about monopolies and antitrust. Hacking, of course, is something that you might think about it as technology risk. So in the overall operational risk picture, that's included. And then just some more subtle things, like on the right-hand side here, you can see the top arrow is miscommunication. So that's kind of general. But I guess that could be like the flash crash and things like that, where someone puts in an order and they leave off 2 zeros or something like that. Or the old, I didn't mean 10, I meant 10%. We also see money laundering is in here. So that's certainly something that, for example, in the book, we deal with outside of operational loss. We do that more in the sense of the AI models that are used to detect money laundering and some of the legal standards that banks have to do. And workers' compensation, so that is flagged here because you might not have enough insurance, you might not have, you know, gotten workers' comp. I have to say this, that I'm a single person entity. And when I consult to an institution such as a Wall Street bank, here in New York State, they require me to have workers' compensation. The idea of workers' compensation in the US is that you have employees. Think about, you know, somebody's working on your house and they have a bunch of employees. The contractor pays whatever, 5 people, 10 people, and one of them falls off a ladder, you know, so that they get hurt on the job. So workers' compensation insurance is supposed to cover some of that. So Wall Street firms think that every company that consults for them has to have workers' compensation. However, workers' compensation is based on the number of employees you have, and I have no employees. I'm just me, myself. So, you know, I tried that argument when this first came up in Morgan Stanley 10, 12 years ago, and I ran it by my accountant, and he said, yeah, you know, technically you don't need workers' compensation, but if they insist on it, and look, it doesn't cost that much, so why don't you just take workers' compensation? A fun fact is that the workers' compensation I usually use is Berkshire, which you may recognize is the company that Warren Buffett owns. So I guess by getting workers' compensation, I'm investing some of my money indirectly, or my corporate monies, with Warren Buffett. All right. So there are different kinds of event types. The These will mean more in the definitions. Think of it also in terms of a hierarchy, that this is the first level of the hierarchy, the event type. Level 2 is a category within that event type. And in the table presented later, level 3 are some of these examples. And the things that were called out before, such as money laundering, associated with that. I should say level 3 are shown with examples. Yeah, so we'll go through each individual one of these, but these were essentially from Basel II, I think. So I'll give the definitions later, but just to give frame of mind on each of these. So IF, which is internal fraud, a good example of that is where Nick Leeson, you know, caused this huge loss in Barings Bank and basically destroyed a bank that had been around for more than 100 years by doing questionable trading practices inside. External fraud, Utz potato chips are common in the US, kind of an iconic brand, but they had a scheme where they worked with their suppliers and, you know, it was corrupt. They over-reported the sales, and they essentially tried to steal about $1.4 million, and that resulted in some prison time and other things. Sorry, itchy nose today. So the employee one is, here's a hypothetical, which I have some experience with. When you lay off people in the United States, you have to make them aware that they can continue their health coverage, health and dental coverage, but they have to opt in a certain period of time, otherwise they lose that. So it's up to the firm to disclose that to the employees, and if they don't do it past a certain date, then they can be fined. So the fine is $110 per employee per day. So, you know, you can easily see that a large layoff, like 10,000 employees, and if you slip up on this for a month or so, it could be, you know, a lot of money. $33 million is serious money for just one layoff, especially when you're trying to save money by laying people off. The London whale is a good example of where processes broke down. It potentially was an $80 billion loss, and it resulted from the difference that the VAR systems in in JP Morgan, which I later worked on as part of the consent order, were specific to commodities or credit or FX or equities. Did I say equities? Anyway, every different asset. Anyway, I don't think I have to go through all of these, but they're all talked about in the book and how they affected things. Just going to breeze through this sort of slowly, not too slowly. Insider trading, not on the firm's account was an interesting one but what you have to know is that if you are an employee of a bank, you may have to do all your trades through the firm's account. I mean, through your account at the firm. That's not you acting on behalf of a client. You're acting on the part of yourself, but you're still using the firm's facilities to do that. So that's risky for the firm. Some things that are included in this are what they call organized labor activities. So that could be union organizing, it could be strikes, things like that. Aggressive sales could be just, finding a little old lady and trying to sell her a stock, which is not an example of know your customer. And in here, I think the second one's kind of interesting because it underscores what we said with VAR a minute ago, that you can have models like VAR models that don't work properly because in that case, they didn't work because the different systems were not synced up to one another. Even if the individual models were working correct on their own, when the total allocation of risk, the total combining the risk was not done properly because the individual things couldn't simply be added together. And then telecommunications, I guess an example of that is, clicking on a link in your corporate phone and getting a virus on the system or scam or something. All right, so when we talk about modeling, I'm going to spend most of my time talking about the advanced models approach because that's really something that you can sink your teeth into as a quant. But let me explain the Basel standard approach, which is basically a one-size-fits-all approach. This is something that you can do, you don't even need Python. I mean, you can do this pretty much in an Excel spreadsheet or even on a piece of paper. And as usual with Basel, the ORC, which is operational risk capital, is expressed as is computed, and then a multiplier of 12.5 to calculate the risk-weighted assets, which is the unit that Basel thinks in. So then it's just sort of algebra. This ORC is the product of a business indicator component, or a BIC, and an internal loss multiplier, ILM. All right. Both of those, as you can see in the green box, come from financial statements. I'll be more specific in a minute, but these are the three components as listed. And also define LC, which is the loss component, or the average annual loss over a 10-year look back. If you don't have 10 years, then 5 years is sometimes accepted. But most banks have some history, although we'll talk more about data later. So these are just sort of accounting things. These are the three components of BI, the business indicator. You can see that both trading book and banking book information is taken here. Then the BIC is basically done from a piecewise continuous function, something like tax brackets. So you look up your total BI, which was the sum of those three terms on the last slide. And then as usual, you apply something to the amount that's less than or equal to €1 billion in this case. Then you look at the amount, maximum €29 in the second bucket. and anything above 30 billion, and so on. So and then you're just like in tax brackets, you're paying more, or there's more risk in having more capital. The internal loss multiplier is, this looks kind of a little bit strange, but basically the heart of this expression is the loss component. Remember, that's the average loss on an annual basis going back 10 years. And then BIC has come from essentially this sum product, or these brackets here. So in some situations, the loss component could be less than or greater than BIC. Both are legitimate, but they say different things about, the how well internal losses are contributing to the total. All right, so the advanced modeling approach is no longer required for Basel RWA, and so it's not a part of regulatory capital. However, just like VAR is not the only way that companies think about, well, just like in the case of VAR, internal economic capital might be a different calculation. It might be 95th percentile instead of 99th percentile, which the regulators want. And it might be calculated daily, where the regulators want 99% less frequently, let's say on a quarterly basis. So, that economic capital, the economic capital for up risk is a good thing to be able to calculate and keep internally. One would think that there'd be operational risk data out there. You have your own trades and things like that. And we'll talk a little bit about the specifics of what that looks like. But the idea is that, you probably don't have enough. So ORX is a consortium of a number of banks, and they basically anonymize data, and they add it up, they accumulate it to get better statistics across those banks. The catch is that it's not publicly available. The only types of information they provide is something like this, and this data is a year and a half old, but it gives you some idea about some losses. It's really not that much different from what I presented before as being examples of losses. But presumably these are ones that they model, and they have some information on that they can then bring to bear and calculate. Earlier, we talked about both a frequency distribution, how often events happen, and a severity distribution. Let's first take the frequency distribution. So, as stated, most people do not have an ORX license. However, we can do some numerical experiments. Note that these are discrete distributions. Everything, events are discrete. I used to be in X-ray astrophysics, and it would be something like particles hitting a detector, or if you like, customers in a bank waiting on a line. But you start to think about Poissonian and other types of discrete distributions. So what we're going to do is we're going to look at Poissonian first. It's the best studied. Then a generalization you may not have seen called the negative binomial distribution. And then a so-called zero inflated Poisson, which deals with the issue that bank data often have a lot of cases where an event is not detected at all. So you've got a lot of zeros. What we're going to do then is for a fixed mean or fixed mean and variance, we're going to simulate from one of these distributions in Python. And we're going to do it for 100, 1,000, and 10,000 realizations, these corresponding to, the type of numbers that we would expect in finance for a sample size. In each case, then, from this realization, we'll compute the sample mean, variance, skew, and kurtosis with standard errors. So the standard errors are important, particularly when you see that the sample size could be pretty small. Last week's talk was MRMD number 13, And there I covered extensively for these first 4 moments of a distribution what the standard errors are. I also covered the standard error of standard deviation, but because of convexity, because of Jensen's inequality, that is actually not a simple form. The variance is easier to calculate. Sample error. So after that, you can then take that sample mean or sample mean invariance and compute what theoretically the distribution is, and then matching the mean or the mean invariance, then calculate the moments and see whether everything's consistent. That is, whether the numbers in part 3, I guess the last one should be part 4, matching the mean, are consistent. So that's saying, if you actually did have something like a Poisson distribution, would you be able to find it, and would you be able to characterize it correctly? I should say that, there is such a thing as fitting to Poissonian distribution, which is this, and then there's a Poissonian regression. So a Poissonian regression could be something like, the Home Depot or whatever hardware store sales is a series of Poisson variables, like how many people show up in the store, how many, suppliers are able to provide this, and so on. This is not Poissonian regression. This is basically just looking at the moments of the distribution and trying to make it, something that we can, it's still a discrete distribution, but a discrete distribution that has certain parameters that we can then use. All right, so the first of these cases is a simple Poisson distribution, which basically is characterized by a single parameter, lambda, which is the mean. And for a Poisson distribution, the variance is actually equal to the mean. Or if you like, the standard deviation is the square root of the mean. So for fixing lambda, let's say call it 5 events, then you can determine the probability. Let's say 5 is the average number of successes, or the average number of things that you, like particles hitting a detector. In our case, it's more the number of losses, and so then for each k, given lambda equals 5, for k equals 0, this gives the probability of that. For k equals 1, and so on and so forth. So I constructed a case where I defined the mean as 5, which means, of course, the variance also has to be 5. And in that case, you can work out that theoretically the skew should be 0.447, kurtosis should be about 0.2. So on the left-hand table, you can see, forgetting for the standard errors for a minute, I compare for 100, 1,000, and 10,000 realizations a random set of variables, and then I look at its sample mean, variance, skew, and excess kurtosis, and then matching that to an actual model, Poisson object in Python, and back derive what the mean, variance, and skew and kurtosis of that are. Well, we've yeah, and in this case, right. So and you can see the numbers are pretty close throughout. The standard errors in parentheses, it's not always that easy to think about that. So on the right-hand table, I expanded it a little bit. So for example, this is the mean plus or minus 2 standard errors. So this is the range in the sample mean. So you see that contains 5.25, which is the matched one. And these are, in almost every case, they're within 2 standard errors. In this case, it's just outside that. But essentially what you're seeing is consistency between the quote unquote, observations, which is the random one, and the matched one. So it shows that we can match Poissonian distributions. And of course, you know, you can also see that, particularly in this case, that the more iterations, the better. And then, as I said in the last talk, you know, like this is a huge error bar on the skew, right? So you can measure anything in this range of a distribution that has actual 0.436 if you only look at 100 random variables. It's hard to establish the significance of a skew in kurtosis, as we said last time, because the standard errors are so large. So you should be skeptical if you look at skew in kurtosis, unless you are on the outer limit of the three cases I considered, 10,000, 20,000, 50,000. But in finance, we usually don't have that many observations. One of the constraints of the whole Poisson problem, though, is that the mean has to be equal to the variance. And in practice, distributions of frequencies of op-risk events do not have that. So can we relax that somehow? Yes, we can't do it arbitrarily, but we could consider cases where the variance is greater than the mean. And I'll show you why that has to be the case. In this case, since we have two parameters, then we have essentially two parameters in the description of the distribution. So the negative binomial distribution, which is sort of an unfortunate name, it tells you it's parameterized by n and p. N is the number of successes before a failure, right? And p is the probability of a success. So essentially it's going on and on, you know, let's say 10 successes and there's a failure, and the failure will happen with probability 1 minus p. So then the PMF, the probability mass function here at the bottom, is referring to the number of failures, there are k of them, before n successes. Now, there are some constraints on both the mean and the variance to make this work. So P is a probability. So of course, in any measure, it has to be between 0 and 1. So then the mean has to be positive, because otherwise the ratio of mean to variance would be negative. Variance is always positive, right? It's a square. And also the variance has to be greater than the mean, because if it were not, I should say greater than or equal to, but if it's greater than it, but the n will blow up if it's equal to. So it has to be greater than it, because otherwise the probability would be greater than or equal to 1. And then n is the mean divided by, so here's this variance over mean, minus 1. And so another way that variance has to be greater than the mean is that the denominator has to be positive. We already restricted the mean to be positive. I guess you could have some bizarre cases where that's not the case, but the easiest ways to think about it is for those two things to obtain. So here's a similar chart, but now using the negative binomial distribution. So in this case, we can talk about inputting a mean and a variance. And mean over variance is the probability of a success. So this is assuming a probability of 0.5. Then you can calculate what the theoretical skew and kurtosis are of that, and do a similar experiments where random is meant to represent actual observed data. And for the three cases we looked at before, 100 realizations, 1,000 and 10,000, we also compare matching. In this case, we're matching the mean and the variance, and we're going to see how close we can get to within the standard errors. So really what we're talking about here is, in this case, I didn't expand, but I think you can still see fairly clearly it's plus or that that all the cases are within plus or minus 2 standard errors. Note, however, that when you first see this 100 number here, you see the skew is 0.725, which is pretty far from 948. So that's why, again, it's important to remember that there is a standard error associated with a small sample. The actual number, is a lot easier to see in 1,000 and 10,000. And similarly, for the kurtosis, then yeah, you really need something. At least without the errors, you can only get close with 10,000 for the skew, for the kurtosis, excess kurtosis. Okay, so another problem that comes up with these is we're going to look at a third distribution, and the problem is if you look back at Poisson, and this could also be generalized to negative binomial, but let's look at Poisson, and you can generalize it on your own. So if you look at the formula, the probability of no events, given that the mean is lambda, is e to the minus lambda. All right, so for example, so what does that mean? So for lambda equals 5, which is what we were using before, there's a less than 1% chance of no events, right? So even at this outer limit of 10,000, you're only going to see on average 67 zeros in your distribution. As we said before, there are a lot of times that there'll be data, has to be properly scrubbed. Obviously, it should only be on trading days that you're recording, but you can have, for other reasons, you may not be measuring these events. They may be, for example, below a certain severity. So, but even if you normalize for that. So the solution is to essentially include a binomial part of this, more like a coin flip, and on the basis of that, decide whether an observation should actually be zeroed out, even if it starts out as a Poissonian one. That means that we need another probability in the picture. So we're going to define pi as the probability of getting a zero. So if you look at the bottom first, you'll see that we have a distribution that if the event is zero, then we go to this expression here. Whereas if the event is greater than zero, then we go to this expression here. And you can check that when pi equals 0, that, the probability is minus y for y equals 0, and the ordinary Poisson expression for an arbitrary value of y, including greater than equal to 0. So I think it's intuitive that the number of zeros is then equal to the total number of data points times this probability here, right? That's the expectation of the number of zeros. So then we can solve back for pi. If we want a certain number of zeros, we can express that as a probability. There are some constraints on that as well, because pi has to be, again, a probability, so it has to be on 0, 1. And so that means, for example, that the number of zeros has to be greater than e to the minus lambda times the total. If you don't have that, then the numerator could be negative. And then, of course, the number of zeros has to be less than the total number. It's a subset. So I'm not doing calculations on how that's applied to actual data, but that's something that we'll do in the book. We'll do a zero inflated Poissonian. So a little bit on severity. One of the ways that people think about severity distributions is to think about truncated normals. So let me just introduce the idea of a truncated normal distribution. And that's something which is parameterized by mu and sigma. And let's just call them that, because they only really are the mean and the standard deviation for an ordinary Gaussian. In this case, we're going to introduce A and B. For an ordinary Gaussian or normal distribution, those would be minus infinity and infinity. But this enables us to do a finite interval, and that brings in as it says in the bullets, this little phi, which is the PDF of the normal distribution of mu and sigma, and the capital F is the CDF. All right, so then what we're targeting this to is the two floors that I discussed before, 20,000 euros or 100,000 euros, because that's within the context of Basel. 20,000 is generally what they have as a de minimis, but larger banks can use 100,000 because the those smaller losses may not be that significant compared to the market cap and so on. So just a little bit of algebra here, and this is what I mean, that the mean is and the mean, variance, and median can be expressed in terms of this alpha parameter, which is A, the floor, expressed in terms of mu and sigma. I'm trying really hard not to say mean and variance. So that, this term, it's easy to see that this term will go away for if A equals 0, so then alpha is mu over sigma. Likewise, the variance is expressed in terms of sigma squared, and you can calculate a median. So what does this look like? Well, let's take a case where we have the mean of the distribution of loss is 50 million euros, and the standard deviation is 25 million euros. So it's fairly strong. I should note that when this is done in Python, you'd like to be able to just input these numbers as the floor, but actually the trunk norm, which I reference in this asterisk here, the trunk norm function takes as input the number of standard deviations of A relative to the mean. So -2, is essentially 0. I guess it's 1.99999. But in the limit that it's 0, you have the normal distribution, and that, of course, brings back 50 million, 25 million, and the median is equal to the mean. The effects of 20,000 and 100,000 euros on something where the mean is 50 million is relatively modest, but you can see a little bit of it. It's not 0. So in specific cases, so there's an effect on the mean, there's an effect on the standard deviation, and on the median as well. They all go up, which intuitively makes sense if you're cutting off part of the distribution, right? That's the truncation, if you cut the low end. So I think I'm going to wrap up here. I've shown you the in reverse order severity distributions that can be truncated and dealt with, frequency distributions that can be modeled in 3 different ways. Those are within the advanced modeling approach for operational risk. I showed the standard approach for operational model risk, operational risk capital, and the risk-weighted assets that Basel requires. And I defined the Basel categories as well as provided some examples. So here's contact information. Let me just go with this, and then I'll be able to give you a few minutes back of your time. It is possible to just use this as the link for this weekly MRMD. There'll be another one next week. I'm not sure exactly. I may start to get a little bit more specific on some of the things that I'm doing with artificial intelligence in the chapter in our book on AI risk. But I may also return to the documentation, the regulatory documentation. So just for UAE, we've talked extensively about Britain and the US, but UAE has some fairly detailed. So that's at least worth, let's say, half of one of these. Some of you may have been listening live on the YouTube channel of my Delta Vega company. and that's great. Otherwise, you can stream it some other time. You can send it to a friend. And all 14 of our shows have been put up there. I'll also send around minutes. And then here's just some information if you want to get in touch with me. I'm in Flatbush, Brooklyn, you may have heard of. And we're mostly 5 hours west of London. Here's an email and here's my LinkedIn. So I thank you for your attention, and I'll stop the share. And I'll give you back some of your time. Hope to see you on a future MRMD on which I sometimes call Mermaid. Hope to see you on Mermaid